recording. And welcome to the Edge live group discussion for June 4. And I'm Tim Quast with Market Structure Edge. With me is Brian Wilson, also a market strategist for Market Structure Edge. And I've got a number of topics. Again, if you have something to ask right off the bat, feel free. Yeah, Richard. So Richard says, why are many stocks selling off at the open recently? It's, one of the things I have on my list of topics today is this incredible disparity that you see pre-market versus the market. And, Richard, I can't tell you precisely, but we certainly understand the mechanics of what's occurring and what could be causing that. In fact, I think Brian was trading notes with one of our users today about that. And John, you might be here. I think you're here. You could speak to this, but we'll come around to that. Let me share my desktop. Give me 1 second here. So the first thing on my list, because I said I would do this, is I've said that the market has been run by supply more than demand. Now, that's just in the latest little cycle, and I want to explain what that means. But Richard, I will not forget to come around to your question about why do stocks sell off and then jump? Why does it look like you have massive disparity between the Dow and the Nasdaq, and then everything's up, and the Dow runs way up, and it's supposed to be the staid index. Of course, there are only 3 industrials in the Dow Jones industrial average, right? And they're like the bottom of the list of the 4 or 5 smallest. I think 3 are industrials. I think Travelers brings up the rear at the bottom of the list. But the top of that list is all the same stocks. I mean, all the same stocks are in the Nasdaq 100, the S&P 500, and the Dow. And so you'd say, well, why then do they diverge? Well, clearly it's an arbitrage trade, right? If you have the same stuff at different prices, that's what it is. And these things I've said, we have a market that is absolutely rife, stuffed with arbitrage trades because of what we have permitted the market to be crammed full of. And, okay, that's what people have clamored for. We want to trade options and futures on everything, and we want leveraged instruments. And so this is what we get. And it's what the regulators permit. Getting to the supply side question here. So as a reminder, we track demand and supply. That's what these 2 graphs show, right? Demand spends most of its time above 5. So the market has a propensity to rise. We just normalize a bunch of data that we consume from exchanges and FINRA and other sources. But we're creating a picture of how trades are executed. And it's highly regulated and very mathematical. Everything right now has to trade between the best bid and it's supposed to. It doesn't mean it always does, but the aim and the requirement in the regulations is there's a bid and there's an offer, and stocks have to trade between those things. So there's a mad scrum to be in the middle, and we can measure that and make a pretty good determination of, is there excess demand? Is demand rising in low volatility? It's going to spend a lot of time right at 5, because what do you get when you blend value and growth? 5 on a 10-point scale. That's effectively what you get. We normalize to a 10-point scale. In momentum, you're going to get stocks that spend a lot of time near 10. I mean, that's the whole point. You want to isolate for things with excess demand and insufficient supply. And there are a bunch of them. If you don't calculate probabilities, 50 of them. It's a big number. If you go to the daily trading ideas portfolio, there are 40. Meaning 10 didn't have a probability of better than 51%. Doesn't mean it's perfect. I want to come around to that too. We'll talk about daily. They work great today. You take, just about your pick, and you can make 2% because of that, Richard, that disparity between how stocks perform at the open and what happens next. But here's the supply. I want to finish answering this question. So the question is, what does it mean when I say, well, it's really been a supply-driven market, not a demand-driven market? Well, I mean this, that from here to where we are now, this is a tremendous decline on the supply side in terms of its length. I mean, clearly, you know, if you're going from 53% of the volume in the stocks comprising the S&P 500 is short versus long, meaning whatever, 53.4, 46.6% long, and you go all the way to 50.2%, you would say, well, on a percentage basis, that isn't that much. But that's a big, long stretch where supply continued to decline. Supply is Reg SHO Rule 201 short volume data. So you have all trades are long or short. So the market, if that's going to be true, and there's a buyer for every seller, which is not true, believe it or not, but let's just keep it simple. Half the volume is going to be long and half it's going to be short. And there are going to be periods where there are imbalances in that. And this was a very big stretch, as was the stretch from here to here, which enabled the market to really gain momentum. Supply can lift the market both directions. You can create stocks, market makers can, to continue to move prices up and people continue to consume it. And then the next leg of that trade would be removing all that excess liquidity. And if demand is fairly steady, you see the demand actually declined, right? It came down to 4.9 all the way down to 4.6, was not strong demand. Yet the market continued to rise. SPY did anyway, because supply declined. This is what I mean, but when I say it's been a supply-driven market, and you could see it all over the place. You could, you know, I pointed out, you know, what did Marvell do? Well, you know, it's really interesting what happened on the supply side to Marvell. It's that's how it rose. You know, it rose because there's a sudden surge on the supply side. If there are no sellers, because Marvell says, well, you know, the holders of Marvell say, well, why would I sell it if Jensen Huang thinks it's going to be the next $1 trillion stock? Well, then how would it go up? It's a pretty simple question. Because for the price to rise, there would have to be somebody willing to sell it at a higher price, except that it's brokers, it's machines, really. It's automated market making that creates stock to fill trades. That has to be squared. There's a long time before it has to, from a regulatory standpoint, be squared. And it could be offset by something else. Maybe those market makers have to sell a bunch of puts. I mean, there are all kinds of things you could do to square value at risk and meet the regulatory requirements. But again, it's a great illustration of that issue. If you look at Broadcom, you know, this is kind of interesting too. You would look at Broadcom ahead of results, and you know, would you look at these data and say, well, that stock's going to lose 350 billion of market cap? Well, no, not necessarily. I mean, demand's rising, so is supply. You know, the problem when demand and supply move in the same direction, it can be both directions. I mean, if there's a sudden surge in demand, the stock's going to rise because people are willing to pay a higher price. If the reverse condition is true, that can cause your stock to drop dramatically because there's excess supply and a sudden, you know, no one shows up. And so but these conditions are all through the market. And you know, it's always telling. If you want to look at whether you're going to buy something, always look at the demand supply balance. You know, it's the thing that most people don't recognize is at the crux of how prices are determined. And even if with all the distortions in the market, is very true that demand supply imbalances will help you. And so if you're going to look at anything, look at the demand supply balance before you make a decision. It doesn't, you know, it's not an absolute. I can't tell you absolutely what will happen as a result of a demand supply imbalance, but you have the central tendency and the probability on your side. I'm going to go down here to the Dow Jones. So you look at this and say, well, demand is very good in the Dow. It's peaked. You know, you take a group of 30 stocks, comprised mostly of tech. We could calculate the percentage, but you know, so it's at 6.1, and so the supply side has come down. It's very significantly long versus the market. It's very significantly long versus the S&P 500. Probably if you looked at I don't know, we could calculate a QQQ too, but it would explain why the Dow would shoot up. It gives you the idea, if something's going to move, which is the long trade and which is the short trade. I like to go look at the short trade by running this portfolio that I call 75% short. It's like, are there stocks out there with more than 73 quarters of the volume coming from borrowed stock? Now, is it a great indicator? No, but it's qualitative. If this is a triple digit number, the market has a lot of excess supply. It's not there yet. The demand is fine in these stocks, but those demand supply imbalances destabilize the market. Okay, so that's why. I mean, this condition has been so significant everywhere that it explains a lot about how the market behaves. I don't know if this is a trend change. You look at big tech, it's had good demand and it's beginning to come down. And supply has risen only if it becomes a trend. It hasn't become a trend yet. This, in the broad market, where demand hits 6 and now supply, that's not yet a trend. I said 3 days at the same level is a trend. That's a trend and a pattern. Sure enough, now it's changing. But 1 day up doesn't mean it's going to continue up. It was also flat for several days here, and then it declined again. So I don't know which direction it goes. Mathematically, I should clarify something I said today. You can calculate what happens to the market when it hits the red line. And, it's pretty easy to calculate. You can go run the data on it and say, well, generally the market just, as Brian Wilson likes to say, it's about 60 basis points. I say 0.5%. At the red line, the market doesn't go up 1, 2, 3, 4%, but it still shows a general tendency to rise. This is the clarification, declines. When demand starts to decline and supply rises in the data, AI will confirm this. It's a pretty easy statistical analysis. The propensity for declines rises stratospherically. I mean, it's kind of amazing. It's like 85% of the time when those conditions exist, the market goes down more than 1%. Could be 5%. I don't know what's going to happen. But statistically, when there is convergence after a long period of divergence, there's a reset. And I would say that is occurring. You see these crazy moves going to that now, Rich. What causes these? Well, I think a lot of it is delta gamma hedging in 0 days to expiration options. So you have the steady decay toward the close. What happens when we move to 23.5 trading? I don't know. And there's so many unanswered questions about that. I traded emails yesterday with one of the guys at IEX, whom we've known them well for a long time. I said, what are you guys planning to do with this? And, here's what I've learned from the NASDAQ, and here are the questions I asked them, and here's what they said. And he said, well, we're not fans of it. I mean, if we talk to institutional investors, they would rather have a shorter market day, so there would be a greater concentration of liquidity to consume. The longer the trading day, the more the prices will be set by arbitrageurs, not by investors. And so if you have the time decay of an option that ends at 4 p.m. Eastern time, and the underlying changing of the prices, you are going to have to swing from one side to the other of that trade. And that's what you're seeing, it becoming so large that the market takes wild swings. When there isn't some disruption to the market, that works. The disruption to the market right now is not exogenous. It's internal. It is what happens when the supply-demand balance changes. Well, you may not know that if you have exposure to delta and gamma risk. And all of a sudden you end up being a buyer when you don't intend to be, or a seller when you don't intend to be. At some point that tips the market over. But Richard, that's to me the reason. That is part of it. And then there's the proliferation of ETFs that all depend on an arbitrage mechanism. They have no prices otherwise. There is no intrinsic value in an ETF. It has no claim on an asset unless you're an authorized participant. Then in the primary market, outside market, off market, you can take a basket of ETF shares and return it to BlackRock and get stock. You and I cannot do that. Right? You and I can only buy and sell the stock or the ETF. We think we own something, but it's like Bitcoin. What is it worth? It's worth what someone will pay for it trading. in that arbitrage trade. So that to you get a market that is full of those things, and that's why I think this is so important. If you don't see demand and supply, you can get caught out thinking that the market is telling you something other than what it is. So Brian, that's kind of what I had to cover aside from
Mhm.
what's ahead. So if you're ready to pick up the baton here, I'll hand it to you, and then we can spend the last 5 minutes collaboratively talking about what's next.
Sure. Sounds good. Quick question for you, Tim. And you talked about this just briefly. Do you think the longer trading day will create larger volatility numbers, in the market over the course of 5 days? What do you think is going to happen to overall volatility?
It's a very good question. It was one of the things that this guy from IEX says. It's Ronan Ryan. We have known Ronan Ryan a long time. He's in the book Flash Boys, which is a great book to read. He's Irish guy. He's funny, and he's just always just a terrific guy. He's honest and direct. But he said the same thing. He said, well, you outside market hours, there is no, what he said is market jargon. There's no order protection rule. What is the order protection rule? OPR, it's called in the jargon of the market. Well, when you trade, you are effectively guaranteed during market hours of getting the best price, which is wherever the best bid and offer, the NBBO, the national best bid and offer, is. Outside market hours, there is no mechanism like that. So you could buy something and somebody else can buy or sell it at a wholly different price. Well, then unless you have a long horizon, you are very likely to end up on the wrong side of that trade. So will we see more volatility? Very likely. It's a problem for public companies. We counsel public companies. It's a core part of, it's a whole separate business, but that's what, Brian and I spend a lot of time trying to help public companies navigate this market. And we encourage them to if they're, when you report results, don't do it after the close, because now you're nothing but a 12-hour arbitrage trade. And you can lose 20% of your value to 3% of the participants who have high speed machines and can consume all the data and know where the price goes. And then here you are sitting out here as a long-term investor, committed to the fundamentals of that business, and you suffer a 20% loss. And so we say to public companies, well, they can't control that, but you can. Why wouldn't you report during market hours where there is an order protection rule and where you have competition versus those machines? They cannot run the market in one direction or the other, because maybe BlackRock will have a different opinion and will step in and be a buyer of size, changing the direction. Why wouldn't you want a level playing field? But that, I think, is going to happen, Brian. Yes, more volatility.
Good point. Joe had a question on NVIDIA. And Joe, why don't I go there? I actually had it on my radar, so we can take a look at that together. And part of what I was looking at with NVIDIA,
Joe, nice to have you here.
Yeah, absolutely.
Yeah.
I appreciate, seeing all the regulars every week. You're part of the family. I really appreciate you guys. But if we look at NVIDIA, and I'd like to run it back either 6 months or a year to try to get a feel for what is the current supply and demand structure. This is a 1 year chart. You can see over time, and short volume has just been moving lower. So very low short volume over time. What's the demand setup? Well, let's take it back to last summer, and you can see we had a stretch of about 3 months where demand was really weak, and NVIDIA price, really suffered. It basically moved sideways. It didn't do anything, but demand told you that it wasn't hitting 10 with any regularity. You can see the beginning of the new year, the same exact thing happened. NVIDIA, it could not get back up to 10. Price moved sideways once again. We've had 2 cycles in a row where it has retraced to 10. I don't know what it's going to do with this cycle. It's 2.6, but you can see what happened. It got up to 10. What happened after it got up to 10? Absolutely nothing. So it's very good in terms of, demand cycles for NVIDIA. It's very predictive in terms of what's going to happen. But Joe, to your question, does this continue to move higher up to 10? I don't know. We're going to have to watch to see how that plays out. I'll circle back to a point that Tim made about short volume, and I'm going to take it back on a 3-year look because I want to show you something that was occurring back at the election. Well, let me go back for a shorter term look. So as Tim mentioned, this one has had two parts so far. So a move lower and then kind of another move lower, and we don't know what happens next. So that being said, let me show you two different periods where we've had significant short covering and then what occurred afterwards. Coming into the election, look at this short volume move lower. And this one kind of was a stair step moving lower. It would move lower, it would stop. When it stopped, notice what happened. Everything would just even out for a period of time. It would move lower. What would happen? Well, broad market returns would even out. It would move lower. What would happen? Finally, when it had its last move lower, this was about a 2-month stretch where the market did absolutely nothing. And we had warned both Tim and I that, hey, beginning of the year, the market might have some issues here because we were tracking what was happening with demand in the broad market leading up to it. But here's the point. After a period of short covering, the market tends to kind of fizzle out for a period. If you get additional short covering, well, the market can continue to move higher. 1025 was another period right through here. So this move lower, what happened to the broad market? Same exact thing. Came under a little bit of pressure for a while, and then the market continued to move higher after that. I don't know what this one looks like. Is it something like this, where it's just a short move lower and then the market continues to move higher? Or is it more like the election, where we had a dramatic pause for a period of time? I'm not sure how that plays out, but that's certainly something that we will want to watch. Quick point, because this is going to affect the markets, and it's probably been impacting the markets already. Obviously, AI is not perfect, but what I ran on Copilot was just I told it to give me kind of a summation ahead of SpaceX coming to market on the 12th. So in other words, what should we anticipate for the broad market? And specifically, I was asked, well, right now they're expecting it to come to market at about 1.8 trillion, which would be the 7th largest company. Target price of 135. That was as of yesterday. So maybe that changes. I don't know, but that was yesterday's data. Assuming the S&P 500 is 500 stocks, it varies a little bit. But I asked AI, like, what happens to the other 493 then? So this would then be a mild drag on smaller stocks. Notice it's going to happen weeks before the inclusion, not just the day of. The days before the inclusion, you get heavier positioning flows. You're going to get market makers that are hedging activity. You're going to get relative underperformance in the other 493. What's going to happen on the 12th? Well, passive funds are going to be buying SpaceX. Is that going to lift price? Let's say it comes to market at 135. Is that going to lift it above 135? Who knows? Sometimes you have the buy the rumor, sell the news type of thing. So I don't know what happens there, but what happens then after inclusion? And once again, recognize this is an AI answer, but it's just giving us a little bit of food for thought as we approach this, which is next Friday. After inclusion, often we'll see a reversal in some of the smaller names, then a normalization of some of the flows. Here's one of the key insights. some of that selling pressure is not just a one-day event. It's a process that's going to start early and then it's going to peak at inclusion. So just something to keep in mind. We did have a couple of questions regarding, how should we trade in the daily names, right? The daily trading ideas and the passive investment portfolio. Couple considerations for you. Tim mentioned that we're hitting the red line and market returns at the red line. We tend to stay above the red line, and this is 6.5 years of data. We tend to stay above the red line for 9 trading days, and that market return is 60 basis points. There's obviously outliers. I don't have time to show you all the outliers today. Please ask me and I can show you that information. I've shown it to you many times before, but we tend to stay there for about 2 weeks, and market returns tend to fizzle out. So that being said, trading becomes kind of choppy, right? So the way that I think about it is if we have an up day, if we have a better day in the market, what's likely to occur the next day? Probably a down day, because that the market returns are going to fizzle out. We won't continue to have that charge higher. So says the last 6.5 years of data. So that's how I would kind of approach things. If we're getting a day where the market's charging hard into the close, probably not going to be buying a lot of names from the momentum portfolio or from our passive portfolio. Why? It's probably a good chance, at least at the open the next day, we might be a little weaker. If we are a little weaker at the open, what's likely to happen then during the rest of the day? It probably recovers. So we're going to get this choppiness here in the market. Once again, central tendency that we're talking about, but we're going to start to see this choppiness being introduced because the market has become extended now. And right now, short volume is starting to move higher as well. That's yet another reason why we probably see these choppy conditions. And I'll stop there for a moment.
Okay, thank you very much, Brian. Yeah, we're about out of time, so we'll do our very brief. I mean that's kind of your look ahead.
It is correct.
Yeah,
correct. Yeah.
The Brad, you asked for the sake of the replay, and by the way, so Joe had asked. I think Joe, if I get this right, you were saying, does the broad market even matter? Is it just NVIDIA? I jokingly call the S&P 500, the S&P Micron, the S&P Intel, NVIDIA, S&P NVIDIA.
Mm-hmm.
So why would one dispense with it? Well, as I wrote today, it still tells us everything we need to know. It is very reliable in that regard. I don't, what happens with tech will all of a sudden end. And we'll be looking around trying to figure out why. There will not be a good explanation for it. So I'm sticking with the big picture, even though looking at big tech is a very good indicator. Brad, you said on a day like this where there are divergences in the major measures. The S&P is up 40 points ish. It's all over the place. Russell 2000 way up. The Dow up 880 points. The New York, I think composite up 286, the NASDAQ down 60. Why does that happen? I would say it's a long short trade. I mean, if you maybe you're buying puts on the NASDAQ and calls on everything else, I don't know. That's determined in large part by machines. Most of that order flow is automated. There are inputs like AI. You give AI a prompt and it comes up with something. The market is very much like that now. So whatever went into the prompt and caused what happened today is heavily influenced by derivatives. And so I agree with Brian. I think these conditions are not normal. When you get those kinds of moves, there is a high probability you're going to get more of them. I mean, you get the boat rocking. And all we need to know is demand is at 6 and it's peaking. Technically, if you were to run a daily average of it, it's declining. So if, and we don't know, I'm watching supply because the market has been a supply run market. What does it do? And it could decline further. I don't know what it's going to do, right? No, we don't know. We're just going to have to watch that. If it rises, now we have the condition that produces a significant move. I don't know when that's going to happen. Generally, it doesn't. Every now and then it does. I will finish with one thing that I want to show you. It goes kind of back to, yeah, so sorry, Brian and I talked, we're ending at 1. But I want to show you this really quickly. This is backing up again to somewhat what Brian talked about. And I always look at this. I look at these drops below the green line because when that happens, when there's been a bear market, it tends to mean it's over. And then you start looking for shoes, and it's not perfect. But if you have a breakdown, below that green line, it's an entry point, but it also tells you things are changing. Whatever pelted the market up probably doesn't exist anymore. And then we get another breakdown. Then we had a very long stretch, and that's shoe number 1. And then you have shoe number 2, and it ended. And then we've had the whole long run. It's a crazy run to here. To me, that is this. That is this. Now, I don't know. I just know that generally then about 3 months from that, or, it's a 3-month gap, 3-month window, then you get shoe number 2, and whatever regime that you have been in ends. And it's a very good read back through the over the whole market. The amount of time has changed, but that condition has been very predictive. And what does it mean? Oh, it's just a measure, right? It's no different than any other measure, but when it occurs, it tends to be a pretty good look. And so I look at this and say, well, it's possible in June, if you carried this out, that you have this. I don't know. You know me. I will look at this and go, well, there's a risk of a pullback. And there may not be. But I'm watching that. And the key will be what happens here. So that's what I will be looking at ahead. And that's all I've got. Good enough. Joe, did we answer your questions? Let's see. I'm not sure that we did, but we'll wrap with that. Looking at the daily of those indexes there, okay, rising green candles. Yeah, I mean, I think, Brad, to your question, I think that reflects the enormous influence of the implied but not obligated supply called derivatives. And it's such an enormous part that we call it 20% of market cap. For any stock, 20% of market cap can go away like that because it gets to market, which is 0. If you expected the stock to do something and you have a right at a future price, and all of a sudden today's price is dramatically different, then the value of those things is 0. And so the same condition can happen at any point in the market. You have to recognize that half the volume is fake, it's short, and 20% of market cap is air, derivatives. Nothing wrong with it. It's just these are facts, and those things can manifest all of a sudden. And I think you're seeing pieces of that today. Maybe it'll be nothing, and maybe it'll be larger.